Hello, and welcome to our next NAP. NAP stands for Nonprofit Auditor Points, and I'm Irina Oshkova, your nonprofit auditor. This video is not authoritative in nature. I am just sharing my experience and knowledge in nonprofit accounting. Let's start. Today's topic's about proper recording of reimbursement expenses. As the auditor, we see sometimes that nonprofits do not communicate clearly within the organization, and when they do see deposit in a bank statement, they're assuming it's some sort of revenue. Typically, it's a contribution revenue. For example, last week, one of our nonprofits received $5,000 from a related foundation. Therefore, bookkeeper took $5,000 and recorded debit cash and credit revenue. Is it always true? No, it's not always correct, especially if you know that this is from related party. So what happened, it could be reimbursement for expenses. Therefore, it's not good procedure, internal procedure, when the bookkeeper see the debit to the bank statement and records it's a revenue, because it could be reimbursement of the expenses. So main concern to understand, there's actually two issues. One issue, nonprofits should not record revenue just because they see money in the bank statement. Number two, you need to understand if the money comes in, what is the nature of this amount. Therefore, every revenue that you record as a bookkeeper records, you need to understand you have to have either contract or grant letter. But very often, bookkeepers even know that it's reimbursement from expenses, and they do record it still as a revenue. This is not the revenue, it's reduction of related expenses. The reason is that reimbursements do not produce any revenue. They are decrease of expenses that was not related to your nonprofit. So where do we as the auditors very often see reimbursements? Very commonly, some nonprofits have related entity. Maybe foundation has related LLC that holds the property. Maybe nonprofit has another entity where does only grant making. Or there's two nonprofits that share expenses. Very common expenses, payroll expenses. So what happened, if two organizations share payroll expenses, one organization records all payroll and then asking for the reimbursement from another entity. And when the funds come in from another entity for reimbursement of expenses, it's not supposed to go to revenue. It's supposed to be a reduction of that expense. Another common expense is employee reimbursement, or maybe board member reimbursement. Sometimes, very often, when the board member spend money for fundraising event, maybe paying for the facility, maybe for some supplies, for some entertaining, and they applying for reimbursement, nonprofit should not record received funds from the when they sending a check to the reimbursement of expenses. They should record as the reduction of related expenses. Or when they receive any check, they need to record it not as a revenue but reduction of expenses. Sometimes we also see when nonprofits received refunds from the vendors. Again, any refunds received, they're not revenue, they're reduction of expenses. Simple example I can tell you. For example, if your nonprofit spent $1 million on behalf of another nonprofit and then ask to reimburse, and nonprofit reimburses $1 million, if your books show $1 million in revenue, $1 million in expenses, that's wrong, because really your nonprofit has no revenue and no expenses. None of them it was yours. Your nonprofits just simply acted like intermediary, just paying expenses on behalf of another related party. So therefore, very often you need to understand the nature of the funds that you receive in your bank statement to understand is it revenue or it's reimbursement of expenses. Otherwise, your profit and loss or statement of activity will be significantly misstated. Your revenue will be overstated and your expenses will be overstated, and it's not proper accounting treatment. Your expenses will be really skewed. Your statement of functional expenses could be skewed. If your nonprofit share payroll expenses with another nonprofit or another entity, if you do not reduce your payroll expenses, you will show significant amount of payroll expenses on your books, and that might skew your percentage allocation on a statement of functional expenses between program, fundraising, and management and admin. Therefore, your books can only carry revenue that belongs to your nonprofit and expenses that belong to your nonprofit. Definition of revenue, it's either donated for your cause or it's exchange transaction, earned revenue. When your nonprofit receive reimbursement for expenses, it's neither exchange transaction or contribution. Therefore, it should not be recorded as a revenue, but rather as decrease of expenses. So closing thought, think of reimbursement like returning the sweater that you bought. It's not a new sweater. If you bought a sweater and you return sweater, your net is zero. So therefore, you should reduce expenses, whatever you're returning back or you're receiving payment, you're reducing the expenses. So really, there is nothing new happening when you are getting reimbursed for expenses. You should not create a new revenue accounts because that's not a revenue on your organization books. Thank you so much. And that was all for the reimbursement. Please make sure that you understand the nature of the debit on your or credit on your bank statement, and record only revenue when it's truly revenue for your organization, and do not record the revenue that does not belong to your entity, but rather it's just reimbursement for previously paid expenses. Thank you, and looking forward to see you for the next snap. Talk to you soon. Bye-bye.